basically, we started talking about receivables, and we discussed that it is important. We said that there are three main issues, accounting issues associated with the receivable. First one is recognizing them. And we said that this is easy. This is what we've been doing so far. For service companies, when they recognize the receivable when they provide the service. So they will debit accounts receivable, credit, service revenue. That's giving that they provide the service on account. Okay? On the other hand, if it is a merchandising company, it's when they make a sale. So basically you have, when the sale obligation is fulfilled, they would debit accounts receivable, credit, sales revenue. That's what we have been doing so far, right? That's nothing new. The second problem is valuing accounts receivable. And the main issue with valuing accounts receivable is how much are we going to report as accounts receivable? What's the problem with the amount that will be reported? What's the problem with accounts receivable? Exactly, not all of them will be paid. So actually, it's Katrina, right? Jane, I'm sorry. I apologize. So, you have certain customers may default on the payment. Not everyone will be able to make the payment on time. Okay? It could be for different reasons. For instance, the customer, if it's a company, they might go bankrupt. If they go bankrupt, you may not collect your money. Sometimes they have shortage on cash, so they might not pay you the money on time. It becomes, if it is, let's say, 210 net 30, the amount must be collected within 30 days. And if not, it will become a different story, right? And then you have, if you were, for example, talking about individuals, like in the recession, recently in 2008, a lot of people lost their houses and lost some, because they lost their jobs, they were not able to make the payment on time, right? This is when a lot of people defaulted. Companies, they have to make some kind of an adjustment. They have to recognize this loss. Okay? This is the main issue here. When are they going to recognize the loss? Okay? This is usually the company will use something called it's called bad debt expense. Bad debt expense is an account, it's an expense that refers to the losses of accounts receivable that were not collected or will never be collected. This is what they also sometimes call it uncollectible. Okay? So the uncollectible account expense or the bad debt expense, those they indicate the amount of money that will never be collected from accounts receivable. How are companies going to make this adjustment to this account? How are they going to actually calculate it? You can do it in one of two ways. Direct write-off. Basically what you do is you have any account receivable that is not collected, you write it off. Write it off, basically you say that, okay, so this account receivable, I'm never going to have it. As a result, this is a loss. And you debit that to bad debt expense. Basically you say that this account doesn't exist anymore. You write it off. There's a problem with the direct write-off method. Who can tell me what the problem is? Yes, go ahead.
Like your balance and punch signature, it's in two different periods.
It is in two different periods. So what's going to happen? Let's say that you make a sale on account in December, okay? And it's due in January. You recognize the revenue in December. Accounts receivable is debited in December. If let's say in January it's not paid and you write it off in January, what happens? You are recognizing the expense in a different period. It's not in the same period as the revenue. And that violates the matching principle, where expenses must follow revenues. They have to be in the same accounting period. This is why if the write-off is material, if it is significant, the company does not have the right under GAAP to use the direct write-off method. Instead, they have to use the allowance method. We will see how the allowance method is done. Now, the direct write-off method is simpler. Any account receivable that is not collected, you write it off. Okay? But in this case, what's happening is that at the end of the year, the value of account receivable that will be most likely overstated, the value of the accounts receivable reported on the balance sheet at the end of the year. Why? Because you are not taking into consideration those accounts receivable that will never be collected, the uncollectible accounts, right? You're not taking that into consideration. As a result, it will not be at the cash realizable value. Cash realizable value is the amount of cash that we expect to actually receive from that account. Okay? So the cash realizable value, it's not, basically the accounts receivable will be stated at the original amount, which does not reflect the actual cash realizable value that they expect to get from those accounts. The other method is allowance method. Okay? The allowance method is mostly talks about, basically the way you do it is in advance, you say that, okay, I expect based on previous history, based on last year and the year before, I expect a certain percentage of my receivables or a certain percentage of my credit sales never to be collected. That's like the average of previous years. You look at the previous years and you say, okay, based on last year's numbers, those are the accounts, because that information you already know it. You know what happened in the past, right? You know which accounts defaulted and which accounts actually were collected. So you can easily calculate the percentage of the uncollectibles. You take that information and you recognize it now in the same accounting period as the revenue. Now this does not mean that this is actually the amounts that are uncollectible. This is an estimation method. So what you're doing here is you're saying, okay, based on last year and the year before, I believe or I think that the amount that will not be collected is, let's say, 7%. We will learn in a few slides, in a while, we will learn how to calculate that. But let's say that, for example, you know that based on previous years, I expect that 7% of my account receivable will not be collected. So you consider this, you recognize those 7% as bad debt expense. You recognize it in advance. Okay, this is why they call it an allowance. It's an allowance method. You allow for 7% to be uncollectible. This may not be exactly the amount. We'll learn later on how to deal with that. Okay? So this is why in this case, accounts receivable would be actually reported at cash realizable value. You are not violating the matching principle because you are matching the bad debt expense with the revenues from that year. So your accounts receivable will be reflecting the amount that you expect to receive. Okay? This is the method that we are supposed to use under GAAP. Let's see how we do that. Just before we move on, to tell you how problematic the direct write-off method can be and why it's not allowed. One of the reasons why it's not allowed under GAAP. Let's say that usually whenever you apply for basically whenever you try to get a computer, for example, on a loan, etc., unless you pay directly using your credit card, you try to get financed by the company. Let's say that you go to Best Buy and you try to buy a laptop for $1,500 and they will finance it. They will run your credit, etc. They will check your credit and your history to make sure that you will be able to pay it in the future, right? Let's say instead, in December, Best Buy, they start some kind of promotion. Anyone, without running any credit checks or any verification methods, anyone can go and buy a laptop and they will finance it. That would be, of course, a huge sale, right? They will be selling, let's say they sold a million, I'm just giving any numbers, a million laptops. Each one of them is 1,500. They will get $1.5 billion, right? As what? Sales revenue. That's in 2015. What happens is that, say that 30% of those who got those laptops, they default in the future. They don't pay. The company did not make any, basically any verifications, they did not check any credits, etc. So there are people who will default on the payments. It's just logic, right? In this case, what happens? 30% of those 1.5 billion, which is like $500 million, will be uncollectible. If you use the direct write-off method, you will be writing off, you will be recognizing an expense in 2016 of $0.5 billion. However, when did you recognize the revenue? In 2015. So what's going to happen is that in 2015, your net income would look very, very nice, and it would look like as if you made a lot of profits in that year. Your net income would be very high. What would happen to your net income in 2016? It will be very, very bad. It will plummet, it will go down significantly. And that will be misleading to your shareholders and to your creditors and to everyone. This is why it's not acceptable. This is just one of the examples that can happen and that could easily happen. Okay? Now the direct write-off method, which like we mentioned, the reason why we mentioned is that usually this is only allowed when it is really immaterial. Some companies, they don't have a lot of this, especially smaller ones. So assume that Warden company, but this is how to write the journal entry for this. Assume that a Warden company writes off Duran's $200 balance as uncollectible on December 12th. How do they do that? It's a direct write-off. They directly write it off from accounts receivable. So what will happen is you debit the expense account, bad debts expense, and you credit accounts receivable for that company. You wrote off the account for that company. Okay? Anyone has any question about the direct write-off method? Now, like we mentioned, this is not the method that companies use. Companies, they use the allowance method. In the allowance method, the company, they are estimating how much will be uncollected. What's the percentage or what's the amount that will be, so that the company will not be able to collect from those accounts receivable. In this case, the company does not, because this is still an estimation, no one has defaulted yet. This is not like someone has defaulted and you're writing off that account. This is where you're saying that I expect this amount to be later on uncollectible. As a result, the company does not know which account receivable specifically, which company will default. Can they know that in advance? They can't. So what they do is, they don't credit accounts receivable directly, because they don't know which account to credit it to. Instead, they credit a contra asset account called allowance for doubtful accounts. Now you guys are familiar with contra accounts. We had contra asset accounts, we had contra revenue accounts. We go back now into contra asset account. Allowance for doubtful accounts. being a contra asset account. What kind of account is it? It's a credit account, right? It has a normal credit balance. So it's in the same way. You want to. This is to record the estimated uncollectible. Before you actually write out the amount. That's done for, let's say that it's in December. You want to make sure that the amount is not actually written off. So at the end of the accounting period, you estimate how much will be uncollectible, how much you expect not to collect, and you debit that amount to bad debt expense, you credit allowance for doubtful accounts. This is an allowance for the accounts that you doubt you will never be collected. Okay, we will see how we calculate those amounts here. Later on, when you write off an account, this is when the customers actually default on the payment. You write off the individual account, but you take that amount not from bad debt expense. You do not recognize any new bad debt expense. You already estimated that. What you do is you credit an allowance for doubtful account because you already recognize the expense. Okay? Because you recognize the expense, now you're saying that the amount that I expected not to receive, I actually did not receive it and I'm writing that amount off. Let's see how this is done. So, Hampton Furniture has credit sales of 1,200,000 in 2015, of which 200,000 remains uncollected at December 31st. What's the balance of accounts receivable? Yes? Yes? That's the value of the credit sales, right? What amount remains uncollected? 200,000. The amounts that remain uncollected, those are accounts receivable, right? So the balance for accounts receivable is $200,000. The manager estimates that out of these $200,000, $12,000 will not be collected. They will not be collected. So those uncollectible, this is the allowance for doubtful accounts. To record it under the allowance method, how do you do that? You always debit bad debt expense, you credit allowance for doubtful accounts. Okay? You do that to make sure that this is the amount that you expect never to receive. Remember, the customers have not defaulted yet. This is why we don't know which customers, and because we don't know which customers, we cannot write off individual or specific account receivables. Yes, Joseph.
So when a company plans ahead and actually uses this method, are they doing so at the very beginning of the year, planning for that current year, or is it the year before and then they just project?
This is basically they project from that. It's at the end of the year. So at the end of the year, they say like a year. You only know the balance of accounts receivable at the end of the year is at the end of the year. The balance for the balance sheet, the balance of accounts receivable that will show up on the balance sheet. That will be the same December 31st. You can calculate it in advance, of course, and see exactly like the percentage and how much you will do that. However, you say that on that day, out of these 200,000, I expect to have, let's say, 10% uncollected. In this case, it's 6%. You say that, okay, 6% out of these amounts will be uncollectible. So this will be the amount that I will recognize as an expense in this period. Okay? This is why when you recognize it is at the end of the year. No, that's not a bad question. It is a good question. Do you do it? When do you do that? You do it at the end of the year because this is when you actually know how much accounts receivable are still uncollected. Uncollected accounts receivable by the end of the year, this is accounts receivable. The uncollected sales are accounts receivable. This is not the uncollectible. Uncollectible are the amounts that you will never collect, or you never expect to collect. Now, how does it show on the balance sheet? On the balance sheet, it's like any contract account, it shows after the account itself. So you have accounts receivable less allowance for doubtful account. This is the amount here is what we call cash realizable value. Sometimes it's also called net realizable value. So cash realizable value is the amount that you expect to receive. It's accounts receivable minus allowance for doubtful accounts. Okay? Any questions? Got it.
When you're actually like when you're kind of like reversing it, when you're
Will it not reverse?
no, I don't know. See, when you debit allowance for doubtful accounts, when is that actually occurring?
This is when you mean the write-off.
Yeah.
We'll see that in a second. Write-off happens when you actually have a client who defaulted on the payment. When the client actually tells you, I'm not going to pay.
But if you're doing that at the end of the year, then how is it going to be the same?
You will not do that in the same period.
It won't be the same.
No, the write-off is not necessarily the same period. You already recognize the expense, the estimation of the expense. So that the allowance itself, the first time we did that was to recognize the expected value that will not be collected in the future. So you are expecting, so basically you are estimating the value that will be written off in the future. When you write it off in the future, you have already recognized the expense. So you're not going to touch the expense anymore. What you'll say is simply, what I expected not to pay, what you expected not to receive, you actually did not receive. Or the amount that you expected customers to default, you actually, there were those customers who actually defaulted in the same amount, or something similar. This is when we record the write-off. As you can see, the write-off is on March 1st. So this is where, there's one thing. The company will not write off immediately accounts receivable. It's not like so the first day after the 30th day, so it's within 30 days the amount was supposed to be paid. It's not like on the 31st day they will write off the account. They will contact the customer. They will try different ways. They will extend the credit. They will do one thing. They will convert it to a loan, etc. It's only when they lose all hope of collecting that account receivable, only then do they write off that account. And this is why usually not everyone has access to writing off the account. Usually only the manager or someone like high in the company who has the authority to write off the account. Because this is money that you will be writing off. You're saying basically that, okay, I'm going to stop trying to get that money. A lot of companies, they will try collecting agencies. They might try to contact the customer themselves and ask them if they wanted to convert the account receivable to a loan that would bear interest, that would lead to accumulating interest. All these things before they actually lose hope. Once they lose hope, they will write it off. This happens after the end of the year. So as you can see, this is the account. It was in the manager decided to write it off on March 1st. That's way after December 31st, 2015. How do you write it off? When you write off an account under the allowance method, you do not touch the expense. You recognize the expense already. What you're doing is you debit allowance for doubtful accounts and you credit accounts receivable for that customer. Okay? In this case, you credit accounts receivable for that customer. You say that, okay, that company account, I'm removing that account from my records. I don't have anyone. Any questions? Yes. Yes.
So like after you give up, if the customer like randomly does pay you.
We will talk about that in 1 or 2 slides. You guys are way ahead of me. Giving me a headache. But that means at least that you are paying attention. That's good. So So I'm not going to complain. I'm happy about that. Because that actually does happen. Sometimes the customer, you have 6 months later, the customer will come back and pay you the money. Probably, let's say that the customer had lost their job, they defaulted on the payment, there was no way for them to pay you back, they got another job, they started making money, and then they wanted to pay their debts. It's not like you are bad people. It's simply, sometimes they simply cannot make a payment. So in this case, what happens? You already wrote off the account. You reverse it. You reverse this entry. Say that, okay, so that write-off, we'll have to reverse it now. But we'll see how this is done. Okay? So this is a comparison. This is basically when you look at the write-off, it does not affect bad debts expense. Okay? The cash realizable value does not change before and after the allowance. Before and after the write-off, I'm sorry. So before and after the write-off, it's not going to affect cash realizable value. Because the cash realizable value, it depends basically on how much you actually originally expected, or your original estimation of the bad debts expense. Okay? Any questions? Okay. Now as you can see, the balance used to be 200,000, now it's 199,500. Because you wrote off 500 from that account. At the same time, your allowance, this is the amount, this is the estimation of the accounts that will be uncollectible. Because it was already written off, so it's taken off from those amounts. Let's do the T account for those transactions and entries. So we start off with accounts receivable. Let's say that accounts receivable at the beginning of the year was 500. Okay? And allowance for doubtful accounts was $25 credit. Remember, it's a credit account. Now, you will see that it's not always that allowance for doubtful accounts will have a zero balance. This is when the amount of write-off is different from the estimation. Remember that this is an estimation, it's not an exact number. So you might write off more accounts receivable than your allowance, or you might write off less. So it could be less or more. Okay? If you wrote off less, you end up with a credit balance. If you wrote off more, you end up with a debit balance. Okay? So let's do that. This is the balance sheet, and we have accounts receivable less the original. This is the cash realizable value. Now this is one way to present it. Sometimes you also might present it like this. It says accounts receivable net of $25 allowance. It says the same thing. It's exactly the same, has the same meaning. It's simply said differently. Okay? It's like saying, for example, when you reach school or when you get to school or when you arrive to school, it's the same meaning. Accounts receivable, net of 25 allowance, or accounts receivable, and then you have underneath it a line item that says, basically an account that says less allowance for doubtful accounts. Okay? It says this, it has the same meaning. So the first journal entry is to recognize, basically this is for credit sale of 100. Credit sale, here we're not including the revenue. Here we're only looking at two accounts. Accounts receivable and allowance for doubtful accounts. Okay? When you have sales for 100, it's a credit sales, that means it's sales on account. You debit accounts receivable, you credit sales revenue. So if we had here another account, if you wanted to do the whole thing, you would have here also service revenue, you credited 100. Sales revenue, sorry. So sales revenue, you would credited 100. Here we don't care about that. At this point, we're only looking at accounts receivable and allowance for doubtful accounts. So let's see how these two are affected. Okay? So we have credit, we have a debit to accounts receivable by 100. You add it here. You debit, you add it to the debit side. Next, we collected 333 on account. What do you do? When you collect a certain amount on account, what happens? You receive cash, right? So you debit cash, you credit accounts receivable. This is the amount that you already received. So you are crediting accounts receivable. You credit accounts receivable 333. Sometimes you write a note next to it that these were collected, if you want. So this is the collection, 333. Again, we're not including the cash account here. So far, we have not touched on the allowance for doubtful accounts. We have an adjustment of $15 for estimated bad debts. This is, at the end, this is where you are trying to, this is where you want to recognize the bad debts expense. What do? You debit bad debts expense and you credit allowance for doubtful accounts. Okay? We are crediting doubtful accounts, so allowance for doubtful accounts will be credited $15. This is based on the estimation, which we will learn how to calculate shortly. Any questions so far? This is straightforward so far, right? Then the company, the management decide, for example, to write off certain accounts that they basically lost hope of ever collecting. In this case, for the write-off, you debit allowance for doubtful accounts, you credit accounts receivable. So it will show on both sides, 10 and 10. This is a write-off. Okay? The balances are shown at the bottom. The new, at the end of the year, the balance sheet will show this amount. It will show 227. This is net of 30 allowance. You can also call it account receivable 257 less allowance for doubtful accounts 30. That would say it in the same way. There is no preference. It simply depends on what the company needs. It exactly has the same name. Any questions about that? This is the cash realizable value. So if in the book they ask you, or in the homework, or in the exam, we ask you about cash realizable value. We're talking about the net value, okay? The allowance deducted from, this is actually deduct the allowance from accounts receivable. Any questions? This is where the company, if they receive the money from the customer after they have written off that account. So they lost hope, they wrote off the account, and then all of a sudden the customer comes back and pays that amount. This is what Jason was asking about. What do you need to do? First of all, you need to reverse that write-off entry. Why is that? Exactly. The account does not exist anymore. You wrote off that account. You said that, okay, and this, when you write off the account, you're saying that this customer does not owe me money anymore. This is it. I'm fed up with it. I'm not going to think, I don't want to think that they will ever pay me. I don't want to add it in my accounts receivable. I'm pretty sure they will never pay me. As a result, I'm fed up with it. I'm writing off that account. So when they write you back, or when they pay you back, now you have to re-establish the account because you already wrote off the account. So you have to re-establish. Otherwise, what are they paying you for? Are they paying you for a new service? No, they are paying you for their debt, to settle their debt. But you already wrote off the debt. You have to reverse it. How do you reverse the write-off? Yes. You debit accounts receivable and you credit allowance for doubtful accounts. This is to re-establish the account. Next step would be to recognize debit cash and credit accounts receivable. This is where you want to recognize for the dance as well. Not just for the correct answer, but for the dance as well. Now, this is where the company is recognizing the receipt of money. Okay? The net effect on the recovery of an uncollectible account, it has zero effect on accounts receivable. As you can see, we debited accounts receivable, we credited accounts receivable. So the balance on accounts receivable will not be changed at all. It will be the same thing. You added the amount and then you removed it immediately. Okay? So you have to keep that in mind. The recovery of write-off will not affect the balance of your accounts receivable. Any questions about that? Okay, we get to the estimation of the allowance of basically on the bad debt expense on here. So far, in the examples and in the journal entries that we made, we were told that the management or the manager estimates basically the uncollectible accounts to be of the value of XYZ. But how do they calculate this? There are one of two ways. So basically they use, generally speaking, companies, they use one of those two methods. Either percentage of sales or percentage of receivables. Percentage of sales, it simply says that, okay, last year we had $100,000 of credit sales, and 7% of these were uncollectible. So if this year you have 200,000, it's still 7% of these amounts of the credit sales. This is the idea of this method, is to try and match the expense. The emphasis here is to emphasize the relationship between the expense, bad debts expense. So this is between bad debt expense and the revenue. So the emphasis here, they call it, the emphasis is on income statement presentation. Expenses and revenues. The other method is, it focuses on the cash realizable value. It focuses on the balance sheet presentation. Basically, what you say is, generally speaking, every year I have 20% of my accounts receivable are uncollectible. So if this year I have $100,000 as account receivable, I expect 20,000 to be uncollectible. Okay, so the allowance for doubtful accounts and the bad debt expense, the estimation would be 20% of the amount of accounts receivable. Now the companies, they use a schedule called the aging method. This is also called the aging method. The reason why it's called the aging method, it simply, we will see that in a second, it follows the age of each account receivable. Because usually, the longer the period, the higher the probability that the customer is not going to pay that amount. If they defaulted for 6 months, it's less likely that this customer will pay you back compared to someone who maybe they forgot to make a payment at the end of the month and they are only late by 5 days. The likelihood of repaying you will go down with time. Okay? This is why they also call it the aging method. Both methods are acceptable. Okay? And for both methods, the company would use previous numbers. They would use last year's numbers. So for the percentage of sales, and like I said, the percentage of sale, the important thing is you look at the sales. So in this example, assume that Gonzalez company elects to use the percentage of sales basis. It concludes that 1% of net credit sales will become uncollectible if net credit sales for 2015 are 800,000. What would be the adjusting entry in this case? The adjusting entry is always the same as far as the accounts are concerned. You debit bad debt expense, you credit allowance for doubtful accounts. Okay? The amount is the only thing that will change depending on which method you use. Okay, in this case it is 8%. It's 1%. 1% multiplied by 800,000. Any questions? Yes.
I thought the percentage of sales method was between the sales and the bad debts expense. So,
Same thing, yeah.
where like the doubtful accounts, where would that come into this? If you could explain that one.
The number is 1% off.
Right. So I'm saying like, how does the basically the difference of like why this one is used versus the other one, like the bad debt on the debit side.
It's always like that.
Okay.
So the debit, you will to record the bad debt expense. You always debit bad debt expense. You credit allowance for doubtful accounts. Whether you use the percentage of sales or whether you use the percentage of accounts of receivables, the only thing that will change is this amount. Basically, the way you estimate the amount. How do you recognize it? This is why, as you can see here, this is when we're doing this. I put here triple X's. It doesn't matter what the number is. In this case, this is based on estimation. So this one is based on estimate. So this is based on company's estimation. And this is where the percentage of sale, or this is where the difference between what method you use. However, as journal entry, you will always debit bad debt expense to recognize the expense and credit allowance for doubtful accounts. Okay? Now, the amount, when you use the percentage of sales, the amount will be for the adjusting entry. So this is for the adjusting entry. That's the adjustment itself. Okay? You'll see in a second why. Remember that when you use the percentage of sales, you are calculating the adjustment itself. Okay? So this is when you start here. At the end of the year, you are making this adjustment to recognize bad debts expense, and allowance for doubtful accounts will be credited the same amount. So this is the adjustment. That's the amount that will go on the adjusting entry. If the allowance for doubtful accounts has a beginning balance, whether debit or credit, you have to take that into consideration when you calculate the ending balance. And like I said, sometimes the companies might have a balance, and most of the time they have a balance in allowance for doubtful account because it's just an estimation. You cannot know in advance exactly how much you will be writing off. Any question about the percentage of sales? We will be solving a couple of problems that will make it a lot easier to understand. Now, the aging method, or the percentage of receivables, this is the schedule that will be used by companies to actually calculate the estimated ending balance. So here, this amount will be the ending balance. That's not the adjustment. So to calculate the adjustment, which will go on which will be entered in the adjusting entry, you will have to add or subtract the beginning balance. So the percentage of sales will give you the adjustments, not the ending balance. When you use percent of receivables, it will give you the ending balance, not the adjustment. And the way companies do it is usually they would categorize their accounts receivable based on their tenure or on the length after the due date. So those are the total amounts. This is not due yet. Okay? This is not due yet. They calculate all of them. Usually, again, based on previous years, the company expects 2% of the not yet due to default. They expect 4% of the ones that are within 1 to 30 days past the due date to default. They expect 10% within the second, within basically 31 to 60 days post due date, and then as you can see, it grows with time. Okay? So for example, if it is over 90 days, 40% of those accounts will never be collected. That's based on previous years. They know these numbers. They can look at last year and see that, okay, those accounts, they were never collected, etc., etc. Now they do the same thing. They basically, this is like looking at previous years and just projecting that percentage or that estimate, projecting that percentage to estimate what this year's uncollectibles will look like. So from each category, you will have a certain amount. You add them together. And that will give you the total ending balance. This is what you call estimated, this is the total estimated bad debt expense. So when you make a journal entry, so assume that unadjusted trial balance shows allowance for doubtful accounts with a credit balance of 528. So doubtful account was 528. Prepare the adjusting entry assuming 2,228 is the estimated or is the estimate of uncollectibles. This one will give you the ending balance. So the ending balance is 2,228. How do you get from the beginning balance to the ending balance? Basically what you have is you have 528 plus adjustment equal 2,228. That's how we need to calculate. How do you write a journal entry? Always the same thing. You debit bad debt expense, you credit allowance for doubtful accounts. The number will be the difference between the beginning balance and the ending balance. That's the adjustment. This is the amount that is given from the aging. This is from the percent of receivables. Any questions? Okay, so as you can see here, it's in the same way. The numbers are different, but we debit with debit bad debts expense, we credit allowance for doubtful accounts. Now, the amount to be entered in the journal entry has to be calculated from the beginning balance and the ending balance. We get the ending balance using the percent of receivables. If we're using the percent of sales, it will directly give us the adjusting amount, the adjustment, or the amount that you will use for the adjusting entry. This is a mistake that I've seen before. When you're using one method, in many cases I had some students who would enter the 2,228 directly as adjustment. That's not the correct way. Okay? Any questions? All right. Now, the closer, as you can see here, percentage of receivables usually gives you a closer estimation or approximation to the cash realizable value, because you're using the accounts receivable themselves, the percent of accounts receivable from the previous amount. And this is the one, like we mentioned before, sometimes it would have a debit balance. Allowance for doubtful accounts would have a debit balance, and this happens when the write-offs are, when you write off more accounts than you actually allowed for, than from the original estimation. You expected to have, like in this example, you expected to have, say, 2,228 at the end, but next year, if you actually write off 3,000, you have written off more than what you had allowed for. And usually, if companies consistently make mistakes between the allowance, basically the amount that was debited, for example, to bad debts expense. So if the estimation is always or consistently higher, they have to readjust their percentages. Basically, they have to tweak it a little bit. So Broom Company have been in business for 5 years. The ledger at the end of the current year shows accounts receivable, 30,000 debit. Sales revenue, 180,000 credit, and allowance for doubtful accounts, 2,000 debit. Bad debt expense, so bad debts are estimated to be 10% of receivables. Prepare the entry to adjust allowance for doubtful accounts. Take a minute to think about it, try it, and let's solve it afterwards. Okay, so how do you solve this? First of all, which method are they using? Percent of sales or of receivables? Percent of receivables. Given that percent of receivables, that will give us the ending balance or the adjustment? Ending balance. So that percent of sales will give you the adjustment. Percent of receivables will give you the ending balance. So in this case, we know that ending balance is equal to 10% multiplied by 30,000. So what's the ending balance? 3,000. So if you have here doubtful accounts, okay, that's fine. Doubtful accounts, originally they had a 2,000 debit balance. You need to have an ending balance of 3,000. This is the amount, 3,000 on the credit side. When you have, because this is a credit balance, it has a normal credit balance, right? So the debit will be minus. So basically what you have here is minus 2,000 plus adjustment equals 3,000. So the adjustment is equal to 3,000 plus 2,000. Any questions? Start. And start. And the second one as well. Yes. That was good. Whenever you have a question like that, you first need to look at what method they are using. So they are using percent of net sales. You know that percent of net sales will give you the adjustment itself, right? It's not going to give you the ending balance. It gives you the adjustment itself. The company, they are using percentage of sales if allowance for doubtful accounts. So you start with doubtful accounts had credit balance of 15,000 before adjustment. What is the balance after adjustment? They are asking us to do what? To calculate the ending balance, right? This is what they want, right? What's the ending balance? It's 15,000. I like it when you guys are so quiet that you don't even tell me that I skipped already to the next question. All of a sudden I look at my screen and it's a different question. And I wonder, where did my writing, lovely handwriting go? But I don't know. No one tells me anything in this class. I hate it. What is the balance? Again, the adjustment will be equal to 1.5% multiplied by net sales, right? Multiplied by 800,000. That's equal to 12,000. So we know that this is 1,000. You just add them up. Any questions? Good. So the second one. Keep your clickers ready because we have a bunch of these. So, again, you first look at which method was used. So which method was used? We have net credit sales, okay, but which method was used? Percent of receivables. We have 10% of the balance in receivables. So we're using percent of receivables. Percent of receivables of accounts receivable will give you what? The ending balance. Okay? So basically what we have here, they are asking you if the accounts receivable balance and December 31st was 100,000, what is the required adjustments to the allowance for doubtful accounts? We have doubtful accounts. The ending balance. So the original, what was the original balance of account for allowance for doubtful accounts? It was a credit of 8,000. And then we have the adjustment. So you have 8,000 plus the adjustment, which could be positive or negative. If adjustment was negative, it would be on the debit side. In this case, we know that it has to be on the credit side because it's for this year. Anyways, it should be equal to 10% of the receivables, which is 10% of 100. You see the net sales? We're not going to use this information here. Okay? You have adjustment. It should be equal to 10,000. Right? What's missing? So you have during 2012, the company also, so let's read it from the beginning. They gave us the net sales. The beginning balance of allowance for doubtful accounts was a credit balance of 8,000. During the year, 15,000 of uncollectible accounts were written off. When you write off accounts receivable, what do? You debit. So we have 15,000 debited. You debited 15,000. So here we have 8,000 minus 15,000 plus adjustment equal to 10,000. Right? And then they tell us that past experience will tell you that this is 10%. The accounts receivable were 10,000, it's 10% of 100,000, I'm sorry, 10% of 100,000 is 10,000. That's the ending balance. just do the math. You have the adjustment or the adjusting entry will be the amount for the amount of 10,000 minus 8,000 plus 7,000, right? Plus, I'm sorry, not 7,000, 15,000, sorry. Which is equal to 17,000. Any questions? Okay. I actually went through the material a little bit faster today to try and solve as many problems as we can. Because I believe, especially for this chapter, solving the problems will help you understand much more than explaining the material as material. Seriously. Okay, still go ahead and solve it. You guys do it on purpose just to bug me or what? Okay. I would be kind enough to give you a smiley face for this one. It's going to be all weird. But not because I did not mean to make it that weird, trust me. Okay, forget about it. Let me see if this one will work. I don't know what's happened. Anyway, you've got stuff, as usual. Now, so you have a question like that, once again, what you do is, you start by identifying which method they use. So in this case, they use aging of accounts receivable. What does it mean? Aging of accounts receivable is the percentage of receivable. We know that the amount is, that will be the ending balance. So the ending balance, that will be challenged. Okay, I'm not going to do that. Which word? You can see it. People write down that they don't. Oh, I cannot do that. So, okay, I'm going to put it right in here. Okay? So what we have here is, we know that ending balance is supposed to be, come on, 108,000. Okay? And those are expected to be uncollectible. At the beginning, we had 70,000 on the credit side. So you have 70,000. Okay? On the credit side, 70,000. Do you have any write-offs? So we have 70,000 plus the adjustment should be equal to 108. That means the adjustment is equal to 38. That's even easier than the question before. Okay? So you might have, it doesn't mean that you will always have one or the other. Okay. So as you can see, the questions are getting harder a little bit, right? Now, okay, so in this question, again, we had sales on account, cash sales, and collection on account. In addition, there was also some collection from previous year. What's the balance on accounts receivable? Okay, so where do you start with? Then had sales on account. Sales on account are what? Accounts receivable. So you had accounts receivable of, let's do this here. Accounts receivable originally were 132. That was a debit. So for debit, I'm going to put plus. It was 132,000. That was what? Sales on account. And then cash sales. We don't care about cash sales. Collection on account. We collected 84,000. In addition, we collected 1,450. Do you add it or subtract it? Actually, you can either not add it or subtract, or you can add it and subtract it. The correct way, if you don't want to make any mistake, remember, you will be re-establishing the account, and then you will be again crediting the account. So what you do is plus 1,450 minus 1,450. Basically, this is how you solve the question. Any questions? Okay, have a good weekend, everyone.